phrase special situation is often used to define a condition or an event that is unusually unique, that is very opportunistic, and most importantly, something that can turn out to be exceedingly profitable. So, there's a lot of incentive in knowing more about this topic, which is why in this video, I shall take you through the different types of special situations, some recent examples so as to give you a better understanding of it, and how one can identify such situations. But let me start off with that word I used in the very beginning, the word unusual. So, why is a special situation unusual? You see, the usual way for a business to make money is through trading, that is, the buying and selling of physical goods and services. Now, where this becomes unusual or special in our case is when companies involve themselves in certain financial transactions that are seen to be creating additional value for its shareholders. For example, and this is a very basic example, but let's say you and a friend each own a spectacle shop, and let's say these are the only optical stores in the entire town. For years, you both have been waging a war, you've kept prices low, you've spent heavily on advertising, and when times were bad, you both have also had to book a loss in your business. Now, the situation becomes a special one when you both decide to stop competing and merge your businesses to create a single optical store, which essentially means there is no more competition and you can set higher prices. Your costs come down as you don't have to spend on advertising, so more profits for the two of you. And with your combined expertise, you can offer better products and services, drawing even more customers. Okay, now that I've explained it this way, and just to define it better, there are three defining characteristics of special situation investing. Number one, these opportunities emerge out of corporate actions and are therefore not directly dependent on the company's product, sales, or the stock price. Secondly, the risk one estimates and expects to take in a special situation opportunity is generally on the lower side. And thirdly, unlike normal investing, a majority of the facts that one needs to build a thesis is already available in the form of corporate announcements, news releases, notices, investor presentations, etc. Right, so let's move on to the main event and start with the first type of special situation, which are mergers and acquisitions. Now, companies often use acquisitions or they merge with each other in order to grow their business. For example, last year we saw the mother of all mergers when HDFC Limited merged with HDFC Bank to create a financial services giant with a combined market cap of over 13 lakh crores and the world's seventh most valuable bank. Of course, the financial side, the business side of this merger was to provide HDFC Bank access to a larger pool of customers from HDFC Limited's housing finance business and enhance their combined product portfolio. In that context, another post I'll highly recommend is the one by Professor Bakshi on the multiple mergers that finally led to the formation of Shriram Finance Limited. Now, an example of an acquisition and a very interesting one is what Imagicaaworld did in February this year when it acquired 5 theme parks for a total consideration of 630 crore rupees. In fact, I covered this event in my newsletter, and because the acquired parks were already operational, the immediate effect of this acquisition was an 80% increase in this year's Q1 revenue and a 114% rise in the company's EBITDA. I've shared more critical details of the transaction in my post, and if all goes according to plan, the company Imagicaaworld should continue to grow at 15-20% for many more years at an unbelievable EBITDA margin of 55%. At the opposite end of mergers are spin-offs and demergers, which involves the separation of a business unit from the parent company. Some examples of this include the separation of Larsen & Toubro and L&T Technology Services, Grasim Industries and Aditya Birla Capital, Reliance Industries and Geo Financial Services, and very recently what's happened with Raymond Limited and Raymond Lifestyle Limited, which I covered in a recent issue of my newsletter explaining where the lifestyle business stands and how it might unlock value in the future. I'm very sorry about this, but I will be mentioning my newsletter multiple times in this video. I know it's a shameless plug, but you know what's more shameless than this? It's if you haven't subscribed to my newsletter yet and have been missing out on the many investment ideas and stories that I've been doling out. Anyways, the objective behind doing spin-offs and demergers is usually to streamline operations, to build greater focus on individual businesses, and of course to unlock value by listing the entities as separate businesses. This is what Tata Motors is aiming to do by separating its passenger vehicle and commercial vehicle divisions. And although this exercise is likely to take another year or so for it to fructify, it still calls for an interesting case study for one to read up and analyze. Okay, I know what you're thinking. You're thinking, itna sara research kaun karega? And it's not just the research, the identification of an opportunity starts even before that, with one having to read through dozens of corporate announcements, research through the available materials, create a thesis around it, get an opinion from others, and stuff like that. So, if you're thinking all this research is hard work, then let me tell you from experience that this is even harder than hard work. Which brings me to Swastika, the sponsors of today's video, and an online stockbroker that offers the three essential things every investor needs: a powerful and reliable trading platform, strong research capabilities, and a personalized investment experience. Now, you might not have heard of Swastika before, but here's a company that's been around for 32 years. It's listed on Bombay Stock Exchange, has won numerous awards, and currently serves over 4 lakh satisfied customers. Swastika takes pride in its team of 804. Yes, you heard that right, 804 highly experienced market experts who provide detailed research reports, market insights, and everything you need to improve your investment and trading decisions. Each client is assigned a dedicated relationship manager who provides personalized recommendations to help traders and especially beginners choose the right stocks, make informed trading decisions, and save both time and potential losses. Additionally, with over 100 branches all across the country, there will always be someone from Swastika to service your needs. Opening an account at Swastika takes just 15 minutes, and with that single account, you can trade in stocks, currencies, futures, options, commodities, and even bonds via multiple channels like online, over the phone, or at a Swastika branch. So if you're looking for a blend of technology, research, and personalized support, Swastika has everything you need. So sign up now, and as always, the link to this platform is available in this video's description. Next up is asset sales, and many companies buy and sell business divisions from time to time as part of their operational restructuring process. Of course, what happens when you offload a part of your business is that you receive a big pile of cash, which can then be partially or fully distributed to the shareholders as special dividend. It's what happened with Imagicaaworld Limited in the year 2020, when this company, which would generally pay a dividend of just 1 or 2 rupees, announced a special dividend of 974 rupees per share, making it one of the biggest dividend jumps that corporate India had seen in recent times. Of course, that's assuming you haven't heard about Vedanta. You see, what happened here is that Imagicaaworld had sold its US business to a private equity firm, which had led to this massive cash accumulation, and with the company having no viable avenue to redeploy this money, they opted for returning it back to the shareholder as special dividend. This is a bit similar to what Aster DM Healthcare did when it sold its GCC business in November last year, and as I predicted in my newsletter, the company did offer a special dividend of 118 rupees per share, and overall this transaction turned out to be very profitable from a total shareholder return perspective. But having said this, there are definitely some risks in such situations that a shareholder will have to take into account. For instance, there's a time gap between when the sale is first announced and when the special dividend was approved. During that gap, like in Aster DM's case, the buyer could have pulled out in the last minute, some regulatory hurdle might have come up, the management might have decided to use this money for buying something else, and so on. So there are multiple scenarios that could have happened, and we as investors need to continue to collect evidence to understand what is most probable in such situations. You or I won't be right all the time, but as I always said, investing is never about being right, it's always about improving one's odds of success. Alright, very simply, a buyback is a situation where a company repurchases its own shares from its existing shareholders. This reduces the number of outstanding shares, often boosting the share price, as investors interpret it as a signal that the company itself believes that its share price is undervalued. This situation often creates short-term trading opportunities, as we saw in episode number 1 of my newsletter, where I explained how one can potentially make an 18% ROI within a single month by participating in the TCS buyback program that had come out in October last year. Since then, several buybacks have been announced, with a notable increase after the budget, when our finance minister declared that proceeds from share buybacks, which were previously tax-free, would now be treated as dividend income and taxed according to an individual's tax slab. I guess this removes the sting out of buybacks, but one can still look at them as a neat short-term money-making opportunity. For companies, buybacks remain a strategic tool to manage capital, reward shareholders, and signal confidence to the market, assuming the company's fundamentals are strong and the buyback is executed at a fair valuation. A rights issue is a very interesting special situation because, okay, let's start with what a rights issue is. So think of a rights issue as a preferential access, that is, the company's existing shareholders are allowed to purchase additional shares in the company, often at a discount to the market price, before any new shares are offered to the general public. The money so raised is typically used for debt reduction or as growth capital, and from a shareholder's perspective, it helps them maintain their proportional ownership in the company. But as I explained in this video using the example of Sandur Manganese, if you aren't careful and aware of a rights issue, then you can lose a lot of money, and some of the other shareholders, typically the company's promoters, would have profited from it at your expense. Now, interestingly, a rights issue can also create arbitrage opportunities for investors who understand the nuances of the offer. I'll take the example of Reliance Industries, who in 2020 raised a little over 53,000 crores through a rights issue. And just to detail this a bit, the rights issue was priced at 1,257 rupees per share, offering a 14% discount to the then market price. The entitlement ratio was set at 1:15, meaning shareholders could buy one additional share for every 15 shares held by them. And very importantly, these were renounceable rights, that is, shareholders could either subscribe to the rights or they could ignore them, or they could even sell their rights entitlement to others in the open market. It's this last part that is most interesting here because, firstly, if you don't want to subscribe to the rights issue, and let's say the rights entitlement or REs as they are commonly called, if the REs were trading at say 200 rupees each, then you can simply sell them at 200 rupees, which would give you a direct profit. So if you had 150 shares of Reliance before the rights issue, then 1:15, you'll receive 10 REs and 200 rupees each would net you a profit of 2,000 without making any investment. A second opportunity is where you could have purchased REs from the market and then subscribed to the rights issue, thereby benefiting from the difference between the combined cost of the REs and the subscription price and the higher market price of RIL shares. For example, let's say REs were trading at 150 rupees, and since the subscription price is 1,257 rupees, your effective purchase price would come to 1,407 rupees. Now, if the market price of Reliance shares was higher, say 1,500 rupees, then you could have sold them off at a nice little profit of 93 rupees per share. I've simplified this entire thing a bit, but the Reliance rights issue is a textbook example of how a well-executed special situation can create multiple avenues for an investor to profit from through thoughtful planning and execution. Okay, now this word corporate restructuring sounds like something a management consultant might suggest, but very simply, it means significant changes to a company's operation structure or financial setup in order to improve its profitability and therefore enhance shareholder value. This kind of restructuring often leads to sudden and significant increase in a company's value or the market's perception of it, which is also why investors closely watch out for these events. A good example of this is the restructuring at Usha Martin Limited. You see, prior to 2018, the company was facing financial stress with its profitability and cash flow severely impacted by the cyclical nature of the steel industry. To address this challenge, Usha Martin decided to divest its steel division to focus on its core wire rope business, which had higher margins and global demand. Therefore, in 2018, the company sold its steel business to Tata Steel for some 4,300 crores, which was then used to reduce debt significantly and focus entirely on its core business. As a result, Usha Martin's financial health improved dramatically, which restored investor confidence and brought about significant appreciation in its stock price. In that context, one of the most successful corporate restructurings in India that has generated huge value for shareholders was the reorganization of the Bajaj Group in the late 2000s, when the group was broken into three separate entities. Bajaj Auto Limited, that retained the core business of manufacturing two-wheelers and three-wheelers. Bajaj Finserv, that took over the financial services segment, including insurance and lending. And thirdly, there was Bajaj Holdings and Investment Limited, that functioned as the holding company for the two entities. I really don't have to tell you how well this restructuring went for the shareholders of Bajaj, as the situation continues to serve as an exemplary case of how a well planned corporate reorganization can create substantial wealth for shareholders. And yes, our job as investors is to identify such situations, understand what the management is up to, and predict confidently where this might lead the company to in the short run and in the long run. Another massive opportunity is the relisting of a company, which, as the term suggests, is when a company that was previously delisted reappears on a stock exchange. This delisting could have happened voluntarily or involuntarily, but what often precedes such a relisting is the reorganization of the company with significant changes in the company structure. Again, this reorganization can happen via a merger, demerger, asset sale, some acquisition, management change, capital restructuring, etc. But this revised version of the company often comes with improved operational efficiency and strategic direction, which more often than not unlocks value for the shareholders, leading to massive price appreciation. The case of Ruchi Soya is relevant here, which was once a major player in the edible oil and soy products market, but faced severe financial difficulties, leading to it getting admitted to the NCLT, the National Company Law Tribunal, for insolvency proceedings in 2017 with dues of over 12,000 crores. Subsequently, the company was delisted from the stock exchanges, and then in 2019, through a competitive bidding process, Patanjali Ayurved, led by Baba Ramdev, acquired Ruchi Soya for 4,350 crores, marking a significant turnaround moment for Ruchi Soya, as this deal brought in much needed capital infusion and management expertise. What followed was a restructuring of operations, integration of product lines with Patanjali's extensive distribution network, product diversification with new categories, and massive debt reduction, which all led to Ruchi Soya getting relisted in the Bombay and National Stock Exchange in January of 2020 at 16 rupees and 10 paise. I mentioned the share price because what followed is unlike something I had ever seen, and the stock went up and up every single day for the next 6 months until it reached a high of some 1,500 odd rupees and almost 100 bagger in a mere 6 months, completing an incredible turnaround story. Fast forward to today, Ruchi Soya Industries goes by the name Patanjali Foods Limited, but more importantly, it serves as an excellent example of wealth creation, of how a troubled company can recover and create value for shareholders. And our eighth and final special situation opportunity that one must be on the lookout for is management change. Right, so a management change refers to the replacement or reorganization of the company's top leadership, including the CEO, board members, and other key executives. This change can be the result of various factors like poor financial performance, strategic realignment, mergers and acquisitions, or even shareholder activism. From an Indian context, a management change can have significant implications due to the often family driven nature of corporate governance, and if done well, it can act as a catalyst for substantial transformations within the company with improved profitability and shareholder value in the long term. I actually learned this the hard way when I missed out on the special situation opportunity with Cupid Limited. Here's what happened. So, Cupid is a leading manufacturer of contraceptives, and when I first invested in that company in 2021, it was available at a market cap of just 300 crores, and it also had about 100 crores of cash in its books. But then I exited my position over the next few quarters as the company's growth and share price seemed to have stalled, with no significant capital or capacity expansion for a pretty long time. What I didn't process then is that things were changing at Cupid, and the first hint of that came in the company's Q4 FY23 earnings call, when an analyst asked their then 78-year-old chairman and MD, Mr. Om Prakash Garg, if the business was up for sale, and Mr. Garg actually gave some interesting insights. I mean, tell me which promoter would actually say on an earnings call that he will happily sell off his 40% stake in the company if someone offered him 300 rupees a share. This might sound ludicrous, but it was a clear tell that the Gargs were old, tired, and a little desperate to exit, and that a new motivated management could have done a much better job. Unfortunately, I missed those clues, and on the 9th of September last year came the news that the Universal Halvasia Group had entered into a definite agreement to buy out the promoters at 285 rupees a share. The acquirers then made an open offer to the company's public shareholders for an additional 26%, and mind you, the price, which for me was stuck at some 200 rupees a share, went up and up to touch 2000 rupees a share, basically a 10 bagger for any investor who understood and analyzed that story properly. My point is, as crucial a company's products and services are, it's the management that converts potential into performance, and there are multiple examples of how a strong leadership has done wonders to a company's fortunes and in the process has created a lot of value for its shareholders. This enhancement in shareholder value has been a common theme for us today, and this concludes our 8 special situation opportunities. My focus in this video was to put all of this together in one place, and if you want more details, then there's always my newsletter, plus you can also examine the work of some other investors on Twitter, blogs, newsletters, etc., and also some of the research that the team at Swastika regularly puts out. Also, if you like to read, then pick up a copy of this book, Investor's Guide to Special Situations in the Stock Market by Maurice Schiller, which is perhaps the most popular book on special situations. To conclude, good investing is all about good hunting, and I believe adding special situation opportunities to a repertoire is a great way of generating above average profits at below average risk. Once again, thank you for your time. Do subscribe to my newsletter. Do like this video, share it with your friends, and I'll see you very soon. Until then.